Now, if you want $5,000 a month for 30 years in retirement, how much in cash do you need? Now, this is not some school maths problem. That's why I know we all moved on from that phase. That's how I'll give you the answer right away. You need 1.8 million in cash if you want $5,000 a month for 30 years in retirement. But if you actually have investment return on that capital, do you know you actually need way less than it? I have actually a calculated number to present to you in a while. Now, today's topic, to get returns on investment, the best way possibly is to invest it into equities. Equity markets can get you returns, high returns. How high? We'll discuss also in a while. That's why today's video, should you put all your retirement money into equities, 100% to it, ride it up and down? Very interesting concept, and I'll actually show you some findings that might really change your perception of how you actually do your retirement planning. With that, let's roll in the intro video. Hi guys, welcome back. Now in today's tutorial, I actually break it down into 6 quick sections, and the first section starts with this. Why equity markets? Why not put into properties? Why not buy bonds? Why equity markets? Let me show you this finding over here. What do you see? This is actually done by New York University, which actually evaluates equities versus gold versus real estate versus bonds. But of course, that is to US situation. Is it different from Singapore? I'm not 100% sure about it. But the main thing is this, if you invest $1 100 years ago, it's very likely it will grow to 1,500 with the equity markets, because equity markets grow. And from this chart, it shows that equities are the best performer, outperforming all the other asset classes. It's reinforced by another study, and this study also shows that equities are indeed the best class to invest into, and specifically small cap equities. That's why I have actually a previous video on small cap equities. This fund has actually delivered more than 8%. So if you're interested, look for the links or look for it in the summary sections after this video. So if you invest in small cap equities, you can do indeed get good returns. But the main thing is this, if you choose to invest into cash investments, do you realize it stays close to inflation only? Cash investments, not cash, which I guess probably refers to fixed deposits, money market funds, etc. etc. Cash investments, you realize that your money doesn't grow. In fact, it's probably close to inflation at certain points and even worse than inflation. So if equities are indeed the best place, what kind of return can you expect from it? Now, what kind of returns really depends on what you invest, as well as what kind of time frame did you get invested into. But I have a few examples to really put some anchoring points to the numbers. The first is if you invest into STI, Straits Times Index. Do you realize that from a 10-year perspective, you have derived 3.1% per annum? But since inception, it's probably doing about 6.5%. Last 10 years for STI wasn't that fantastic. That's why so many are shooting down STI, saying that it's not a good investment place. They are recommending S&P 500, and if we look at this chart over here, you realize that S&P 500 has delivered for past 10 years 13.8%, and since inception 15.3%. If you have followed this channel, you do know that I'm bullish on Chinese equities. So what does Chinese equities deliver in returns? Let's look at this chart over here. You realize that for Chinese tech sector, it has delivered 11.8% for the last 10 years, and since inception, more than 12%. Now, I think it's not fair to conclude that S&P 500 and Chinese equities are better than STI. It really depends. It could also mean that they are overvalued in comparison to STI index. What I want to draw is 5.25% per annum is actually a very realistic number to project long-term equity returns, because you are very likely to be able to achieve that if you stay the course. That is why this chart done by a colleague of mine actually holds some weight. It assumes that if you want $5,000 a month for 30 years and you can get 5.25% year in, year out, do you know that you only need little more than $900,000 instead of the original $1.8 million? That exact number is actually $905,462. And in this theoretical graph, you can deliver 5.25% year in, year out. You can actually deplete it slowly across the next 30 years. Now, therein lies an assumption. 5.25% is year in, year out. But equity markets don't react like that, correct? There are ups and downs, and that's why it ties into the next point. Now, if you have benefited, smash that like button, because it has taken our team hours to prepare this whole presentation for you. We've gone to the part that equity markets, if they deliver you returns 5.25% per annum, you can actually use much less capital to last for 30 years. But equity markets are not consistent. They go up a lot, they come down, and they go up again. That is why, if you factor in market volatility, what would a graph actually look like? This colleague of mine has actually done certain assumptions. He's actually charted against the volatility of MSCI Singapore over the 30-year frame. And you know, markets, if you look at this chart over here, are generally on the uptrend, correct? But there are always peaks and crashes. But as I look at this chart, I actually did some research also. From my understanding, this MSCI Singapore is only formed in 1986. But that's not the main focus. The focus is actually on the two red arrows that I'll draw for you over here. What do you realize? These are big market crashes, correct? What are they? They are firstly .com crash and Asian financial crisis. And that leads to the next question. What if you withdraw 5,000 per month still in a bear market? What would the portfolio look like? Now you do know when markets actually go up, you can actually just take out the gains, correct? And the principal is intact. Very nice situation. But what happens in a bear market, just like the two I've mentioned, Asian financial crisis as well as .com bubble crash? What happens is your portfolio actually experiences a double whammy. Because firstly, prices are coming down, and when they come down, you're still withdrawing, selling out at potential losses. If you have $905,462 and you invest it with 5.25% per annum, and you put it into the markets like what we've seen in the graph, you realize that your monies only last for 23 years now instead of 30 years. The key question is this 5.25% including dividends or not? But let's simplify. If you buy a fund that reinvests your dividends and you draw out the capital, it makes the equation a lot simpler. You realize that this graph really drops significantly after 1997 and 2000. These two are fatal blows to the portfolio, which can really be a situation you face if you choose to put 100% of your cash into equities for your retirement. So what can we do about it? That leads to point number 5, which is when it's a bear market coming down, don't sell out, don't withdraw this $5,000 per month. Logical, correct? Simple enough, correct? But also lies in a problem because you can't go without expenses, you can't eat nothing also. I understand that. That's why we're going to talk about solution. If you see a bear market and you stop withdrawal, where can you consume from? The first simple idea is actually from your CPF. Now, if you're a Singaporean and if your CPF is well stocked enough, firstly, you need to have an enhanced retirement sum, which means 1.5 times the full retirement sum, and it will actually pay you $2,000 to $3,000 after your age of 65. But that's still age of 65. You want to retire earlier than 65. The second method you need to understand is if you have enough in your CPF, OA and SA, after the age of 55, you can actually use up for your withdrawal. That is assuming you have the full retirement sum fully done. Now, do you know actually how the CPF retirement account works? If you are not sure, look for this tutorial I've done before or look for links below for that video itself. Over there, I'll explain how CPF special account shielding actually works, how you can actually still keep CPF special account after the age of 55 and get 4% rate of return. Could that possibly save you from withdrawing with losses? Think about it. So let's put certain numbers to things. If you have $905,000 in cash, surplus one, get it fully invested in the equity markets. Get that 5.25% that we have discussed so far. And then you aim to actually fill up your CPF enhanced retirement sum, the full amount of it. And yet still have enough in your CPF special account. Let's put a number to it, $100,000 there for rainy days. When bear markets come, you withdraw $5,000 per month from that pot. Do you realize something? You actually can simulate this whole discussion that we've done so far and yet prolong your amounts of monies with much lesser than $1.8 million. But I understand the question you may have is that how can you get to such a situation? Obviously, you do need to have high income, correct? To have enough cash, fill up your CPF sufficiently, clear away all your debts for retirement. It's not easy to do without a high income. And a lot of high income earners actually do not have time to get used to investment markets, put time to understand investments, appoint someone to invest properly. And therefore, there are articles that have shown before, high income earners have actually a lot of cash, yet very little investment experience. If you are in this situation, look for my links below. I can actually help you with a full retirement plan and answer the various questions that you may have. So point number 6 is back to the point of expenses. Now, in your retirement years, aim to have very little fixed expenses, which means clear away all your mortgage, avoid taking a car loan, and if you have certain property conservancy charges, sinking fund charges and stuff, consider downgrading your property. Now, that helps you in your retirement years. You have a lot more flexibility. You need a lot less for retirement. And that's actually a topic that I've touched on even more in a previous video I've done. Check out this video over here. You realize that in this video, I've actually gave my reactions to this idea of having 1 million extra funds in 10 years time. Check it out. I may actually have more tips that you can benefit from. With that, I'll sign off from here and see you there. Take care and goodbye.